A market master of the day is Dheeraj Agarwal. He's co-head equities, Ambit Capital. Dheeraj, great to have you back on the program. Thank you very much for your time. You know, we're down about 17 now, but on any time frame, a month, a quarter, you want to stretch it to a year, just amazing amount of outperformance, relative outperformance, absolute outperformance to the big market, which is the US market, and of course to other emerging markets as well, Dheeraj. What's your sense? Where do we go from here?
I think the outperformance continues. So a number of things in India which actually protects us from the current mayhem which is happening globally, particularly on the rates and the currency side. Our total external debt to GDP is very, very manageable and very low at about 20%. And that, I think, is one of the biggest factors which shields us from the happenings of the global market at this point of time. Second, remember that we didn't fall into the trap during the COVID time of just going ahead and printing and pumping money. Some of that is coming back to roost at this point of time in many markets in the world. We also have an inflation issue, but far lesser and far more manageable as compared to many other economies. And of course, blow-ups if we're talking about emerging markets, look at the big bets or some of the big bets GEM investors made 2 years ago, including Russia and China, and for reasons specific to those two countries, those are blowing up. So India really stands out.
Okay, the Nifty low is 17,539. We're at 17,551 now. Why is that important? Yesterday's low was 17,532. So in a contracting market, you do tend to take support at previous day's low and then tend to make a move at the pivot if that happens. So it'll be interesting to see if the market's made at least the first hour low and can move up. Dheeraj, hi, good morning. The big debate is on the big sectors, right? Financials and IT. How are they going to perform? Financials have seen big outperformance. IT has seen a big underperformance. I'm talking about the last 6 months. Your view on both these big ones?
We think the trend continues. IT is exposed to global markets, particularly the US. And despite the fact that IT stocks are down between 30-35% in the last 6 or 8 months, if one looks at valuations, they are still about 20% premium to the average valuations pre-COVID levels, whereas the growth is actually trending back to its normal pre-COVID levels. The bump that we saw during 21, 22 is actually normalizing very, very fast, both on growth and margins. Banks, on the other hand, at this point of time is in a sweet spot. The margins are looking quite okay. Volumes, which is the credit growth, is rising. There is no NPL issue at this point. Purely domestic focused sector, absolutely no impact of what's happening globally. So despite the fact that a few banks are probably reaching valuation levels where they're no longer, I would say, cheap or have a large upside anymore, but they continue to outperform, we think.
Okay, they continue to outperform. Dheeraj, good morning. I wanted your thoughts on, the topic of the moment, which is the Tata Group, the Tata Steel amalgamation of its 7 subsidiaries. We just heard from the management where they'd mentioned that there's about 1,500 crores of cost savings that they'll see because of amalgamation. Now, these are what large groups do, and they do well, right? I mean, this is a great way to sort of simplify the group structure, bring in synergies. It's good for shareholders as well. But on the other hand, you also have the overarching theme, which is a slide in metal prices and lower demand. So how do you approach a name like Tata Steel?
So we like metal space. In fact, I'll try to answer your second question first, because the first one we'll have to look deeper, although it's obviously a simplification of structure, which is very, very welcome. But on the second one, there is a weaker global demand. There is slide in metal prices. But this is very, very different from other metal recessionary trends that we have seen in the last 25 years. In every other previous weakness cycle for metals, the metal companies typically tend to drop into losses because of high amount of leverage on the balance sheet and very poor cost management. As compared to that, let's say Tata Steel, the name that you quoted, Tata Steel in this down cycle will still make more than 10% ROE. So typically metal stocks, if you buy in a down cycle and just hold it for some time with patience, you make a lot of money. And in this down cycle, if Tata Steel is making 10% ROE, if you invest here and hold it for 2 years or 3 years, there's a lot of return to be made. So metals are clearly in an accumulate phase according to us. This down cycle is very, very different from the previous down cycles we have seen.
Okay, down cycle very different from previous down cycles we've seen. Dheeraj, so what is the research team really focused on at Ambit in terms of trying to find opportunities? You guys put out a list of ideas, largely mid and small caps, which could do well. Very diverse sectors, interesting names, lesser talked about. Is that the segment to really focus on with larger caps perhaps more or less fully priced?
Mid sectors are basically so diverse that trying to paint them in one single brush and just looking at it from an index level becomes slightly difficult. Because the 80-20 rule works really well in the mid and the small sector. Only 20% or maybe even less than 20% of the companies actually tend to do very well and are actual value creators. And hence, if you try to look at them at a basket, sometimes you feel underwhelmed. For example, even in the last 10 or 15 years, the outperformance of the mid-cap index over Nifty is just 100-120 basis points per year. It's not that significant considering one thinks there should be better outperformance investing in younger and faster growing companies. So our mid-cap approach is clearly more bottom-up, look for very, very high quality, high growth companies which can sustain a little bit of toughness in the environment. And we've been doing a lot of work around that. Some of the fantastic thematic work that we have done in the recent past is how smaller companies and even larger companies create sustainable value if their incremental ROCs are better than their WACC. And this is actually reflected not just in P's and price to book, which sometimes appear overinflated, but in their EV by IC. So a lot of good ideas out there, but in the current environment, one has to find a bit harder to find them.
The market's very volatile. It's sort of trying to protect yesterday's low. Infosys is trying to sort of come back a bit and help the market. But the bank Nifty has turned weak all of a sudden. A lot of this could be attributed also to the way the currency market has moved and also the fears of FI outflows. Because, the names like HDFC Bank, Kotak, HDFC, these are the names which are dragging it. There was a nice outperformance building in for these stocks, but now all of a sudden there's this decline. And my sense is most of this is macro in nature because of what's happening, especially in the currency market. Dheeraj, we saw a nice bit of inflows into August. The general belief was that it was a lot of ETF money which came in because, it sensed some outperformance for our market and there were problems with the other markets like China. Do you reckon this could be at risk and we could go back to the larger trend of FI outflows?
We think that the worst of the outflows is behind. So if you see cumulative outflows between October and till June or July of this year, FI sold roughly 230, 240 basis points of India's market cap, which is actually slightly higher than the net selling that we saw during the GFC months, which was also around about 200 basis points of India's market cap. So, 2 data points doesn't make it a trend, but I think it's fair to say that bulk of the froth, hot money, profit booking, leverage money, whatever you call it, is probably taken out. But at the same time, I would like to caution that the strong inflows of $8-9 billion that we saw between August and first half September, that pace also may not continue because a lot of focus at this point of time is on how high the US rates can go, how high the US 10-year can go. What does it do to overall flows? What does it do to the risk assets? India is not considered to be a risk asset anymore, unlike many other emerging markets, but it can impact a little bit of flows. So I would not extrapolate the strong inflows of August and September, but I would also think that going back to the huge selling that we saw between October and June is probably not going to get repeated.
Okay. We spoke about the metal space, the IT space, but one space that has done really well in this week itself is FMCG. Whether it's HUL, Britannia, ITC, Titan, they've come back in a big way, paint companies as well. This domestic consumption theme, is it something that you like? And if yes, which pocket offers both value and growth now?
Actually, FMCG is very expensive at this point, so there's no value there. the thing which is working in FMCG's favor in the short run, and it's been working not just this week, but if you actually zoom out a little bit more over the last 2 or 3 quarters, is finally they are seeing some softness in their raw mat cost pressures, and hence the huge GRM cuts that we saw for FMCG in let's say second half of 21 and first half of 22 is beginning to soften. But at the same time, a lot of FMCG companies have taken very steep price hikes, but nobody is actually rolling back those price hikes. So there could be some positive margin reports which will come in because of this particular factor, and that's what is helping that whole space. Some less, some more. Also, there's a slight bit of volatility in the global markets once again, the typical rush to defensive sectors, etc. That also drives a little bit of a money flow.
Dheeraj, it's a pleasure. Thank you very much as always. Good speaking with you here on the channel. Thanks indeed.